What if I told you that most retirees don't run out of money because they didn't save enough, but because they misunderstood how retirement income actually works? Here's the uncomfortable truth for 2025 and beyond. Retirement success is not about hitting a magical net worth number. It's about cash flow, monthly income versus monthly expenses. That's it. Simple. Yet most people are still judging their readiness by looking at a 401k balance and panicking. If you have a pension and Social Security, you're already standing on one of the strongest financial foundations available today. The problem? Most people don't realize its real value. Hi, I'm Imran, instructor of finance courses and data analyst. Let's put numbers on it. Using conservative planning rules in 2025, a retirement portfolio of $500,000 can safely generate around $1,600 to $1,700 per month before tax. Now, pause for a second. If your pension pays you that same amount every month for life, economically, that pension behaves like owning a $500,000 investment account. That's a mindset shift most retirees never make. Guaranteed income is powerful. It reduces stress, lowers market risk, and creates stability during recessions, inflation spikes, and market crashes. In fact, retirees without pensions often need larger portfolios just to replicate the same security. So if your pension plus Social Security already covers your basic lifestyle, housing, food, utilities, insurance, you are not behind. You're ahead. The mistake people make is thinking, I should have saved more, instead of asking, is my income designed correctly? And that brings us to the silent threat that slowly destroys even strong retirement plans. Because even guaranteed income can fail if it doesn't grow fast enough. Let's talk about inflation, the real retirement killer.
The part 2, inflation, the quiet enemy no one plans for. Look, market crashes make headlines, but inflation quietly steals your lifestyle 1 year at a time. In 2025, retirees are learning this lesson the hard way. Inflation may have cooled from the extreme highs of 2022, but everyday costs, groceries, insurance, property taxes, healthcare, are still rising faster than most pensions. Here's the problem. Many pensions have no cost of living adjustment at all. Some offer a flat 1% or 2% annual increase. That sounds reasonable until inflation runs at 4%, 5%, or higher, which we've seen multiple times in the last decade. Social Security does provide COLA increases. For example, recent adjustments have hovered around the 3% range. But here's what most people miss. These increases are not guaranteed by formula forever. They are policy decisions. Even small changes, like reducing COLA growth by a fraction of a percent, can significantly reduce lifetime income when compounded over 20 to 30 years. Now, layer in reality. Healthcare costs historically rise faster than inflation. Home insurance premiums have surged in many U.S. states. Property taxes rarely go down. And basic living expenses don't politely wait for income adjustments to catch up. This is why smart retirees don't rely only on pensions and Social Security to handle inflation. They build flexible income layers, investments, part-time income, delayed Social Security strategies, or inflation-hedged assets. The goal is simple. Don't let fixed income fight a moving target alone. But inflation isn't the only thing retirees underestimate. The next mistake is even more common, and it starts with saying, I only need about $4,000 a month.
Look, almost every retiree underestimates their expenses. Not sometimes, almost always. Here's why. People think in monthly bills, not real life. Rent or mortgage, groceries, utilities, those are easy. But retirement expenses don't arrive neatly every month. Travel to see family, medical deductibles, home repairs, new cars, gifts, weddings, helping adult children. These costs don't show up monthly, but they absolutely show up consistently over time. In 2025 planning sessions, a common pattern keeps repeating. Someone says they need $4,000 per month to live comfortably. Then we review their actual spending over the last 2 to 3 years, and the real number is closer to $5,000 or even $5,300 per month. The best retirement budget isn't a guess, it's history. Another overlooked detail? Taxes. Your expenses are paid with after-tax dollars. Your pension and withdrawals are usually taxed before you ever see the money. When pension income stacks with Social Security and required minimum distributions, taxes can quietly eat a larger portion than expected. This is why strong retirement plans are built using real numbers, not hopeful estimates. Real spending, real tax rates, real inflation assumptions. If your income exceeds your true expenses with margin, you're safe. If it doesn't, no amount of optimism will fix that later. And now we reach the issue most couples avoid completely until one phone call changes everything. The last but the least, Part 4, the survivor income mistake that ruins everything. One of the most dangerous retirement mistakes isn't about money. It's about what happens when one spouse is suddenly gone. Here's the hard reality. When one spouse passes away, income often drops immediately. One Social Security benefit disappears. Pension survivor benefits may be reduced or not exist at all depending on the original election. But expenses? They barely fall. The mortgage usually stays the same. Property taxes don't change. Insurance costs remain. Utilities and food decrease only slightly. Yet the household may lose 30 to 50% of its income overnight. This is where otherwise solid retirement plans quietly fail. Every retirement plan should be tested under 2 scenarios: life together and life as a survivor. This isn't pessimism, it's responsibility, especially in 2025 when longevity is increasing and healthcare costs remain unpredictable. Choosing the right pension survivor option, coordinating Social Security claiming strategies, and maintaining flexible income sources can make the difference between stability and financial stress at the worst possible time. So here's the framework to remember. Retirement works when real income exceeds real expenses. Inflation almost always outpaces fixed income. Most people spend more than they think. Survivor planning is not optional, it's essential. Retirement planning isn't about predicting the future perfectly. It's about clarity, adaptability, and understanding where the real risks live. If retirement is within the next 10 years, this is the window where the right decisions matter most and the wrong ones cost the most.